$100 a week, it sounds like a small commitment, but it's the exact fuel you need to build a massive financial engine. The goal is simple: $1,000 a month in pure passive income. That's $12,000 a year flowing into your pocket without you lifting a finger. This isn't just about the money, it's about the time it buys you. It's about having the option to walk away from a job you don't love. But to hit that number, we have to master the math of dividend yields. The yield determines exactly how much capital you need to save. Dividend yield is the annual dividend payment divided by the stock price. It's essentially the interest rate on your investment. At a conservative 3% yield, your target portfolio value is $400,000. This is the safest, most stable path. 3% is typical for massive, blue-chip companies that have been around for decades and have very safe payouts. If you can optimize for a 4% yield, that target drops significantly to $300,000. This is where most dividend investors aim. Achieving 4% requires a mix of high-yield sectors like utilities and real estate, combined with traditional dividend growth stocks. And at 5%, the goal becomes even more attainable at $240,000. But remember, higher yield often means higher risk. A 5% yield is achievable, but it requires more active monitoring to ensure the companies aren't cutting their dividends. Now, let's talk about the timeline. How long does it actually take to reach these numbers by investing just $100 a week? Your progress depends on total return, the combination of the dividends you receive and the increase in the value of the stocks themselves. Phase 1 is the grind. In the first 5 years, your weekly $100 contributions are the main driver of your growth. By year 5, you've invested $26,000. Your dividends are starting to pay for small things, like your monthly phone bill. This is the hardest part psychologically because the numbers look small. But this is exactly where most people quit, and that's a huge mistake. Discipline in these first few years is what separates those who reach financial freedom from those who stay in the rat race. Phase 2 is where the momentum shifts. Between year 5 and 15, the magic of compounding starts to outpace your contributions. Compounding is often called the eighth wonder of the world. It is the process where your earnings start to earn their own earnings. Every dividend you receive is immediately funneled back into buying more shares. This is called DRIP, or Dividend Reinvestment Plan. You are essentially using your money's children to go out and work for you, bringing back more money children of their own. Hitting your first $100,000 is the hardest part. Once you're there, the math starts to work exponentially in your favor. At this stage, a good market week can increase your portfolio value by more than your entire year's worth of contributions. In the final stretch, the capital appreciation of your assets combines with your dividends to accelerate your path to the finish line. This is the true snowball effect. Your dividends are now large enough to buy significant new shares every single month. Now, let's talk about exactly what to buy. The quality of your assets determines the reliability of your future income. The gold standard for many is SCHD. It offers a perfect balance of yield and dividend growth, making it a favorite for income investors. It tracks the Dow Jones U.S. Dividend 100 Index, focusing on companies with sustainable and growing payouts. SCHD doesn't just look for high yields, it looks for healthy balance sheets and strong cash flow to protect your income. Vanguard's VYM is another powerhouse. It's highly diversified, giving you exposure to over 400 dividend-paying stocks. Because VYM is so broad, it's incredibly stable. You aren't relying on any single company or sector to keep your plan on track. If you have a longer time horizon, look at VIG. The starting yield is lower, but the dividend growth rate is historically much higher. A stock that pays 2% today but grows that dividend by 10% annually will eventually pay you way more than a stagnant high yielder. This leads to a high yield on cost. Your original investment might eventually pay you 10 or 20% based on what you originally paid. Warning: do not chase high yields. A company paying 10% might be doing so because its business is failing. This is a yield trap. If a yield looks too good to be true, check the payout ratio. If they are paying out more than they earn, the dividend is at risk. Focus on dividend aristocrats, companies that have increased their dividends for at least 25 consecutive years. Stability is key. Don't put all your eggs in one basket. Mix your ETFs to capture different sectors of the economy for maximum safety. Consumer staples, like food and hygiene products, are incredibly reliable because people need them regardless of the economy. Utilities are another safe haven. Everyone pays their electric and water bills, providing a steady stream of cash for dividends. Real estate investment trusts, or REITs, can provide higher immediate income and are required by law to pay out 90% of their taxable income. REITs allow you to be a landlord without ever having to fix a toilet or chase down a tenant for rent. It is pure passive real estate. While most stocks pay quarterly, some assets pay monthly, helping you smooth out your cash flow for a true monthly income feel. By mixing quarterly and monthly payers, you can ensure that your bank account receives a fresh injection of cash almost every single week. To keep more of what you earn, consider a Roth IRA. In this account, your dividends grow and can be withdrawn completely tax-free. Outside of a Roth account, you'll pay taxes on your dividends every year. This tax drag can significantly slow down your progress. Understanding the difference between qualified and ordinary dividends is crucial for optimizing your tax bill. Choose a brokerage that offers fractional shares. This allows you to invest your full $100 every week, no matter the stock price. Fractional shares ensure that every single penny of your $100 is working for you immediately without sitting as idle cash. Automate the process. Set up a recurring transfer so you never have to remember to invest. Automation removes emotion from the equation. When you automate, you stop being an investor who makes decisions and start being a saver who follows a system. Systems win. When the market crashes, do not panic. For a dividend investor, a crash is just a sale. Your $100 buys more shares when prices are low. Market downturns are actually the times when your long-term income potential increases the most because you are buying yield at a discount. Dividend growth stocks are a natural hedge against inflation because companies raise prices and then raise their dividends to match. Inflation eats your purchasing power, but a growing dividend stream can actually outpace inflation, keeping you wealthy for life. Reaching $1,000 a month isn't just about the money. It's about the time it buys you back. It's true financial freedom. That $1,000 might cover your rent, your groceries, or your car payment, giving you a safety net that most people never achieve. Once you hit $1,000, the system is proven. You can scale it to $2,000, $5,000, or even $10,000 a month. The principles are the same whether you are starting with $10 or $10,000. The math doesn't lie. The biggest challenge isn't the math, it's the waiting. Patience is the most valuable asset in your portfolio. Good investing is boring. If you want excitement, go to the casino. If you want wealth, stick to the plan for 20 years. Do the math for your own lifestyle. How much would an extra $12,000 a year change your life today? Imagine waking up and knowing that your basic needs are met before you even get out of bed. That is the power of this plan. 20 years from now, you will look back at this moment as the turning point, the day you decided to start. The journey of 1,000 miles begins with a single step. For you, it begins with a single $100 bill. Don't wait for the perfect time. Start with your first $100 this week. Your future self is counting on you. The plan is in your hands. Now take action.